you can't amend to make retirement contributions. And so some retirement contributions have to be made before the end of the year. Some contributions can be made up till the time that the tax return is filed. But if you've already filed that tax return, you can't then amend so that you can make up those contributions. Yeah, so the first one, the easiest one, is going to be an IRA. This isn't actually a business account, but you do have to have earned income in order to make IRA contributions, whether it's traditional or Roth. And whether it's traditional or Roth, that's definitely a different video, but we'll get into that. So after IRA contributions, then we have the option of, as a business owner, you have the option of setting up SEP IRAs, simple IRAs, which are both retirement accounts, are both retirement accounts for businesses. And they're similar to, but different from a 401k contribution, from a 401k retirement account. And there really are benefits to each one. And probably one of the biggest determining factors of which account you want to set up is going to be based on whether you have employees and what your objectives are. If your objective is to offer great benefits to retain your employees, to retain and keep and attract good top talent, then you're going to want to do something that offers those employees those benefits right away. But sometimes you'll set up these retirement accounts with the intention that most of your employees can't qualify for it because you just want to be the one that can make as much contributions to your retirement account, but you don't necessarily want to be funding your employees' retirement accounts. So that's the honest truth. So if you set up a solo 401k, for instance, under the right set of circumstances, you can contribute up to like $70,000 or even $80,000 if you're over 50 years old. And if you're in the 37% tax bracket, that's going to be, think of it like a 37% discount, right? You're going to pay $80,000 in, and you're going to move that money into your retirement account. For the benefit of doing that, you're going to save like almost $30,000 in taxes. So it kind of only cost you $50,000 is what it feels like. Most retirement accounts do need to be created before the end of the year. There are a few that can be created after the end of the year, again, as long as you had qualifying income during that tax year. But it's just simpler to get it set up before the end of the year. And honestly, the sooner you make those contributions, like instead of waiting till, if you know you're going to be able to, and you're planning on it, instead of waiting until next year to make them, even if you can, letting your money grow in those accounts tax-free is also a benefit. So that's just something to consider. Well, retirement contributions are going to be based off of your earned income. And so, or the benefit, part of the benefit of retirement contributions is going to be based off of your earned income. So by Q4, hopefully we have an idea of how much earned income you have, which can help determine how much you can contribute, how much you can from a legal perspective, but also how much you can from a cash flow perspective, how much can this individual actually contribute. And also, are we in a higher tax bracket? Are we in a lower tax bracket? That'll determine whether or not we want to make traditional retirement account contributions versus Roth contributions, for instance. Yeah, so this really isn't a tax benefit. You're going to get the deduction whether you make it in January or whether you make it in December as a lump sum, or whether you make it evenly throughout the year or even after the year in some circumstances. But the unknown factor, of course, is what is the market doing? If it's in a year where the market is constantly going up, of course you would have been better off making all those contributions in January and then letting it grow tax-free throughout the entire year. Of course, that's unknown. Nobody has their crystal ball, and you don't know if it's going to go up or down or stay level. So going throughout the year and just being a steady investor generally is going to be your best bet, safest bet. What you need to get started does depend on the type of business that you have, the type of tax entity that you are. If you're an S-Corp, for instance, which is something we've talked a lot about, your retirement contributions are going to be based off of your W-2 income. And so that plays a factor into how much we want to pay you through wages. If your goal is to contribute more to retirement, then that's an argument for paying you more, or that's the position you're going to take. We're going to look for reasons to pay you more. So it does depend on the type of account. An IRA is very simple, and it's generally the cheapest account to set up. Solo 401ks, generally 401ks or defined benefit plans are going to be more expensive and takes more time and planning.